Two of the biggest stock market indices, S&P 500 and Dow Jones, are constantly in the spotlight. But what's the difference, and which one should you follow? Whether you're a beginner or a trader, let's break it down in simple terms. Let's start with the S&P 500. It tracks 500 of the largest U.S. companies across every major sector: tech, healthcare, finance, energy, you name it. If you want to understand how the entire economy is performing, the S&P 500 is your go-to. Now, the Dow Jones Industrial Average? It's different. It only tracks 30 companies, blue-chip giants like Apple, Coca-Cola, and Boeing. These are stable, well-established companies, making the Dow more focused on industrial and consumer-driven performance. Here's a key difference. The S&P 500 is market cap weighted, meaning bigger companies like Apple or Microsoft have a larger influence. Meanwhile, the Dow is price weighted, so the stock price, not size, decides its impact. That's why the two indices often move differently. The S&P tends to react sharply to tech and high-growth sectors, while the Dow moves slower, reflecting broader economic stability. Think of it this way: S&P equals broad growth. Dow equals solid reliability. So, which one fits your investing style? Are you aiming for growth and innovation, or do you prefer steady, blue-chip stability? Comment below. Type S&P for growth or Dow for stability. And don't forget to hit like, subscribe, and turn on notifications. More quick and easy stock market breakdowns are coming your way.